The irrational escalation is the tendency people have for repeating a type of decision that has been producing bad outcomes instead of deviating from such type of decision to correct the course. This idea reflects the slippery slope quality of our minds in the intermediary terms of a losing streak. This cascading effect I referenced a few times over the course is precisely the irrational escalation effect. This is a cognitive bias because, mathematically speaking, there should not be any cascading effect at all. For example, let's say that a trader risks $1 per trade and we can measure how bad he feels when a trade is indeed lost with the same units, so when he loses $1, he will feel a negative effect equivalent to -1. Here is where the irrational escalation really occurs. If the trader loses another trade, his emotional state won't be equivalent to -2. It will be a little worse than that. Something along the lines of -2.5 perhaps. This effect keeps increasing with each sequential losing trade until a winning trade appears or a margin call happens. Weirdly, when we invert this situation, the irrational escalation doesn't occur so dramatically or doesn't happen at all. Notice there is a clear disadvantage here, meaning that it is a lot easier to feel bad emotions while in a losing streak than it is to feel good emotions in a winning streak. The irrational escalation can lead to a state of fight or flight where the trader fully triggers his primitive behaviors, which is something that always ends in disaster.